silver to $3,947 an ounce. That's not my number. That's the number that went viral this week when Tavi Costa from Azuria Capital shared a calculation that made the entire precious metals community lose its mind. And I'll be honest with you, when I first saw that number, I thought it was insane. Then I sat down and actually decoded the math, step by step, every assumption, every ratio, every historical precedent. And what I found is that the math is not insane at all. The assumptions behind it are where the real debate is. And by the end of this video, you're going to understand exactly where I agree with Tavi Costa, where I think he's being too aggressive, and what I believe the realistic target range for silver actually is. Because even my conservative version of his math gave me a number that changed how I think about this market. Let's start from the beginning. And I mean the real beginning. Because to understand why someone credible is putting out a number like $3,947 for silver, you need to understand the relationship between U.S. government debt and gold. This is the foundation of the entire calculation. During World War II, the United States had massive debt. Everyone knows that. But what most people don't know is that at the peak of that debt expansion, roughly 51% of all federal debt was backed by gold reserves. Half. The U.S. government had enough gold to cover half of everything it owed. And that gold standard, that discipline, that anchor, is what gave the dollar its credibility during the most expensive war in human history. Now fast forward to today. U.S. government debt is even larger relative to the economy. But the percentage of that debt backed by gold has collapsed from 51% to roughly 3%. 3. The U.S. still has 261.5 million ounces of gold sitting in its reserves. Same gold. But the debt has exploded around it. So the ratio between what we owe and what we have in the vault has gone from 51 to 3. I want you to look at this chart because it tells the story better than I can. On the screen right now, you can see U.S. gold reserves as a percentage of government debt going back to 1920. That spike in the 1940s at 51% is the World War II era. Then it drops. But notice something. In 1980, it was back up to 18%. That wasn't because we bought more gold. That was because the price of gold went up so much during the 70s that the value of our reserves increased relative to debt. Gold repriced itself to reflect the debt reality. And that's the key insight in Tavi Costa's argument. Welcome to the hidden economy. If you're new to channel, subscribe. I'm decoding market data like this every single day. The charts, the ratios, the math that most channels won't break down for you. If you can hit the hype button, it really helps. And what I'm about to show you next is going to blow your mind. This is where the big number comes from. If the U.S. government's gold reserves were ever revalued to back 51% of current federal debt, the way they did during World War II, the total value of those reserves would need to be roughly $20 trillion. You divide 20 trillion by 261.5 million ounces, and you get a gold price of approximately $75,000 per ounce. Gold at $75,000. That's where the $3,947 silver number comes from. Because if you take $75,000 gold and apply a gold to silver ratio of 19, you get silver at $3,947. Now, is this realistic? Let me give you my honest take. The math is correct. I checked it. 20 trillion divided by 261.5 million ounces does equal roughly 75,000. And a gold-silver ratio of 19 has been hit before in history. So mathematically, the number checks out. But this is where I start asking harder questions. First question, is 51% debt backing coming back? I don't think so. No government on earth is going back to a full gold standard. That era is over. The world runs on fiat currency and central bank credibility now, not gold bars in a vault. So using 51% as your baseline is the most extreme version of this calculation. But that doesn't mean the exercise is worthless. Far from it. Because even if you cut that 51% in half to 25%, gold would need to be around 37,000. Cut it to 18%, which is where we were in 1980, and gold would need to be 26,000. Cut it to just 10%, barely above where we are now, and gold still needs to be roughly $15,000 per ounce. 3x from today. So the question isn't whether gold is undervalued relative to debt. It clearly is. The question is how much of that gap gets closed, and history says it always gets partially closed during periods of debt stress. 1933, 1980, and potentially now. That brings me to the second piece of Tavi Costa's framework. And honestly, this is the part I find most compelling. The Dow priced in gold. There's a chart that compresses over 100 years of market psychology into a single line. It's the Dow Jones divided by the price of gold. When this ratio is high, it means stocks are expensive relative to gold. When it's low, it means gold is expensive relative to stocks. And this ratio has a very clear pattern. It peaked in 1929, crashed into 1933, peaked again in 1966, crashed into 1980, peaked again in 1999 at an all-time high of 44.8. And it's been falling since then with a failed rally in between. Right now, the Dow-Gold ratio is 9.85. And this is the part that caught my attention. In 1973, right before the biggest gold bull market in modern history, the Dow-Gold ratio was at roughly the same level it is today. Around 10. From there, it fell all the way to 1 by 1980. Gold went from 180 to 850, a 4.5x move. The pattern has repeated 3 times in 100 years. Every time stocks get extremely overvalued relative to gold, gold catches up. Every single time. And right now, we're sitting at the same starting point as 1973. Tavi Costa uses a target of 2.5 for this ratio, not 1, which was the extreme low, 2.5. He's aiming for the middle of the move, not the bottom. And I actually respect that approach because trying to catch the exact bottom is how you get killed in markets. If the Dow stays roughly where it is, around 49,500, and the Dow-Gold ratio drops to 2.5, that implies a gold price of roughly $19,800. The math is simple. 49,500 divided by 2.5 equals 19,800. Now I ran my own version of this. What if the ratio only goes to 5 instead of 2.5? That gives you gold at roughly 9,900. Call it 10,000. Still a double from here. What if it goes to 3.5? That's gold at roughly 14,000. The point is, regardless of where exactly this ratio bottoms, gold has massive room to run based on a 100-year pattern that has never failed to complete. And I think the assumption that the Dow stays flat is actually reasonable. In the 1970s, the stock market's low came in 1973, several years before gold peaked at the end of that decade. The Dow was basically flat for the entire decade while gold exploded. The same setup exists today. Stocks are overvalued. Debt is exploding. Inflation is sticky. Geopolitical tension is escalating. That's not an environment where stocks rally hard. That's an environment where gold reprices against stocks. And there's something that Tavi Costa said that I think most people skimmed over but is actually critical. He said he doesn't think the real bottom in the Dow-Gold ratio was set in 2011, and I agree with him. After 2011, global debt didn't stabilize, it exploded. Every major economy printed money like there was no tomorrow. In past cycles, the Dow-Gold trough coincided with debt becoming manageable again. In the 1930s, debt was wiped out through deflation. In the 1970s, it was wiped out because inflation destroyed the real value of what was owed. Both of those processes were brutal. Both were great for gold and silver. And neither has happened yet in this cycle. The debt problem is bigger today than it was in 2011, which means the repricing cycle is not complete. We're still in the middle of it. Think about that for a second. If the 2011 gold peak wasn't the cycle bottom in the Dow-Gold ratio, then the move we're seeing now isn't a new cycle. It's the continuation of a cycle that started in 1999 and still hasn't finished. That changes everything about how you think about gold and silver targets. We're not at the beginning of something new. We're in the middle of something that's been building for 25 years. Now let's talk about silver, because this is where it gets really exciting and really controversial at the same time. The third piece of the puzzle is the gold to silver ratio. Right now, gold is above 5,100 and silver is above 84. That puts the current ratio at roughly 60.7. When Tavi ran his numbers a few weeks ago, gold was at 5,042 and silver was at 77, giving a ratio of 65. The ratio has already started compressing. 1 ounce of gold buys you about 60 ounces of silver today. That ratio has been as high as 125 during the COVID crash in March 2020, and it's been as low as 14 in January 1980. Tavi Costa uses a target of 19 for this ratio. His reasoning is that 19 is conservative relative to the 1980 low of 14. And I want to be fair to him. He's not using the extreme. He's using a level above the extreme. But this is where I have my first real disagreement, and I want to be honest about it. A gold-silver ratio of 19 has only been hit once in the last 50 years. Once. In 1980, during the Hunt brothers era, when 2 billionaires were actively trying to corner the silver market. Before that, you have to go back to periods when silver was an official monetary metal used in circulation. Today, silver is not a monetary metal. Central banks don't buy it. They don't hold it in reserves. It's primarily an industrial metal with investment demand on top. Does that mean the ratio can't compress? No, it compresses in every precious metals bull market, but does it compress all the way to 19? That's a big assumption. And I think it's the most aggressive assumption in the entire framework. Let me show you what I think is more realistic. In the 1970s bull market, before the Hunt brothers distorted everything, the gold-silver ratio got down to about 30 to 35. During the 2011 silver rally, it got to about 31. So a range of 30 to 40 is where this ratio naturally wants to go during a precious metals bull market without extreme speculative events. Now watch what happens to the numbers when I adjust this one assumption. This is where I started to really pay attention. Tavi's version. Gold 19,800, ratio 19, silver equals $1,042. That's his number. Aggressive but mathematically sound. My conservative version. Gold 19,800, ratio 35. Silver equals $566. I looked at that number and I thought, okay, that's more grounded. But then I realized $566. That's still a 7x from here. On a conservative estimate, my moderate version, gold 19,800, ratio 25. Silver equals $792. That's the middle ground. And it's still almost 10x, even more conservative. Gold at only 15,000, ratio 35. Silver still equals $428. I deliberately made every assumption as boring as possible here, and I still got over 400. That's when it hit me. Every single version of this math, even the most conservative one, gives you silver above $400. That's almost 5x from today's price. And the aggressive version gives you over 1,000. Forget 3,947 for a second. Even the boring version of this analysis says silver could go 5 to 10x from current levels over the next 5 to 7 years. Now I need to address the bear case, because if I only showed you the bullish math, I'd be doing you a disservice. And honestly, there's a smart argument against all of this that I saw in the comments section of Tavi Costa's post. And when I read it, I paused, because the person made a point that deserves a real answer, not a dismissal. The argument goes like this. Tavi Costa ignores the supply side. As silver prices rise, mining becomes more profitable, more silver gets produced, and that increased supply pushes the price back down. Silver is a commodity. It responds to price signals. You can't just extrapolate ratios without accounting for the fact that higher prices create more supply. It's a good argument. And the person who made it also pointed out that silver is a purely industrial metal today, not a monetary metal, and that you can't put gold and silver on the same level because central banks buy gold, but they don't buy silver. These are valid points. And I'm not going to dismiss them, but I am going to challenge them with data. Let's start with the supply argument. If higher prices cause higher mining output, which causes prices to fall, then why didn't that happen in the 1970s? Gold went from $35 to $850. That's a 24x move. Silver went from under $2 to $50. That's a 25x move. Mining did increase during that period, but it didn't matter. The demand side was so overwhelming that supply couldn't keep up. Why? Because opening a new mine takes 7 to 10 years. Expanding existing production takes 3 to 5 years. The supply response is slow. The demand surge is fast. By the time new supply comes online, the price has already moved. And I want you to really sit with that for a second, because this is the part the bears never have a good answer for. In the last 100 years, there have been 2 major periods where excessive debt was effectively wiped out. The first was the deflationary collapse of the 1930s. The second was the inflationary explosion of the 1970s. Both were catastrophic for paper assets. Both were incredible for gold and silver, and in neither case did increased mining supply prevent the rally. The macro force of debt repricing overwhelmed the micro force of increased production. It wasn't even close. Now look at what's happening today. Because this is where it gets personal for anyone holding silver right now. Silver has been in a supply deficit for 5 consecutive years. Prices have tripled, and we still can't get enough silver. Refineries are backed up until April. Mints aren't taking orders. The largest bullion dealer in Singapore just reported 8-hour queues. COMEX vaults are draining at 20 million ounces a month. If higher prices solve the supply problem, it would be solved by now. It's not. And it won't be solved for years because the mines that need to be built to close the deficit haven't even been permitted yet. That's the reality the bears don't want to acknowledge. You can't mine silver that doesn't exist any faster than you can create gold that doesn't exist. Now the monetary metal argument. This one is more nuanced, and honestly, the bears have half a point here. Silver is not a monetary metal today. Central banks don't buy it. That's true. And that means silver doesn't get the same sovereign bid that gold gets. Gold has central banks buying 2,500 tons a year. Silver doesn't have that buyer. That matters. But here's what I think the bears are missing. Gold wasn't really a monetary metal in 1971 either. Nixon had just taken the U.S. off the gold standard. Gold was being demonetized. Central banks were sellers, not buyers. And gold still went 24x in the next decade. Silver still went 25x. The remonetization argument works in retrospect, but it wasn't the driver at the time. The driver was debt, inflation, and loss of confidence in the currency. Sound familiar? And there's something else. Silver may not be monetary today, but it's strategic. The US government added silver to the critical minerals list. That's not a monetary designation. That's an industrial and military designation, which arguably makes it more important than being monetary. You can survive without silver coins. You can't build solar panels, missiles, electronics, or medical equipment without silver. Industrial demand is growing, not shrinking. And when you combine growing industrial demand with investment demand and constrained supply, the monetary argument becomes less important. I also want to address one more thing. The comment said, until central banks start buying silver, the thesis doesn't work. I'd flip that around. Central banks aren't buying silver yet. What happens to the price when they start? If the gold-silver ratio compresses even partially because sovereign buyers enter the silver market, the move could be faster and more violent than anyone expects. The fact that they haven't bought yet is not a bearish argument. It's dry powder. So where does all of this leave us? Let me give you my honest framework. And I want to start with the risks, because I'd be lying to you if I said there were no scenarios where this thesis fails. And I don't want to be that guy on YouTube who only shows you the upside. That's not how markets work, and that's not how I think. Risk number one. Central banks successfully bring debt under control without a currency crisis. If governments somehow manage to cut spending, reduce deficits, and stabilize debt to GDP ratios without causing a recession, the pressure on gold to reprice diminishes. I think this is extremely unlikely given the political environment in every major economy, but it's possible. Risk number two. A severe global recession crashes everything, including precious metals, temporarily. In 2008, gold initially dropped before it rallied. Silver got crushed. If we get a liquidity crisis where everyone sells everything for cash, silver could take a hit in the short term, even if the long-term thesis is intact. Risk number three. Technology disrupts silver demand. If someone invents a silver substitute for solar panels or electronics that's cheaper and equally effective, the industrial demand pillar weakens. I don't see this happening in the next decade, but dismissing it entirely would be dishonest. Now, with those risks acknowledged, this is what I think. Tavi Costa's directional thesis is correct. Gold is deeply undervalued relative to debt. The Dow-Gold ratio suggests we are at the beginning of a major repricing cycle, and silver will outperform gold during that cycle because it always does when these ratios compress. His gold target of 19,800 is within the range of possibility if this cycle mirrors the 1970s. The math works. The historical precedent supports it. Where I disagree is the gold-silver ratio target of 19. Too aggressive for a base case. Not impossible, but I'd use 30 to 35 for a conservative estimate and 20 to 25 for an optimistic one. And the $3,947 silver number? That's a theoretical ceiling, not a realistic target. It requires both the most extreme debt backing scenario and the most extreme ratio compression happening at the same time. Could it happen? Mathematically, yes. Will it? No, I wouldn't bet on that specific number. But I'll tell you what I would bet on. Even using my most conservative assumptions, silver comes out above $400. Using moderate assumptions, it comes up between $500 and $800. Using optimistic, but not extreme assumptions, it breaks $1,000. The timeline matters too. Tavi Costa's analysis points to 2030 to 2033. This matches the 70s pattern where this ratio took about 7 years to move from the zone we're in now to its final low. This isn't a next month call. It's a multi-year thesis, and I think that actually makes it more credible, not less. Let me put this in perspective, because I know numbers like $400 or $1,000 silver sound abstract. Silver is trading above $84 today. If it goes to $400, that's almost a 5x. A $10,000 position becomes close to $50,000. If it goes to $600, that's roughly a 7x. $10,000 becomes $70,000. If it goes to $1,000, that's almost a 12x. $10,000 becomes nearly $120,000. These are life-changing returns, and they don't require the extreme $3,947 scenario to play out. They just require the same thing that's happened in every precious metals bull market in the last 100 years. Ratios that are stretched to one extreme swing back toward the other. And this is the part that I keep coming back to when I think about this analysis. The people who bought gold in 1973 at $180 were told they were crazy. Gold had just been demonetized. The government said it wasn't money anymore. Mainstream economists said it was a relic. 7 years later, it hit 850. The people who bought at 180 made 4.5x. The people who waited until it was obvious missed most of the move. We're sitting at that same 1973 moment right now. The Dow-Gold ratio is literally at the same level. The debt situation is actually worse, and the crowd is still skeptical. Two ratios, the Dow priced in gold and gold priced in silver. Both are near extremes right now. Both have reverted in every historical cycle. And if they revert even partially this time, silver goes to levels that most people today would call insane. Just like people in 1973 would have called $800 gold insane. It happened 7 years later. I want to leave you with one thought that keeps me up at night. The entire precious metals market, gold and silver combined, is tiny compared to global debt. Total above-ground silver is worth maybe $200 billion at current prices. Global debt is over $300 trillion. That's a 1,500 to 1 mismatch. When even a small fraction of that debt reality gets priced into precious metals, the moves are not 10 or 20%. They're multiples. The math isn't complicated. The pool of metal is small, the ocean of debt is massive, and the dam between them is cracking. And there are catalysts that could accelerate this faster than Tavi Costa's 2030 to 2033 timeline. A currency crisis in a major economy, a sovereign debt downgrade of the United States, a sudden loss of confidence in the dollar as the global reserve currency, a major central bank announcing silver reserves for the first time. Any one of these would compress the timeline dramatically. You wouldn't need 7 years, you might need 2. And the thing about these catalysts is that they're not fantasy scenarios. They're the logical conclusion of the current trajectory. When you're adding $2 trillion to the national debt every single year, eventually the math catches up. The question isn't if, it's when. And when it does, you don't want to be the person who looked at the Dow Gold chart, understood the pattern, and still didn't act. Now, let me connect this to what's happening right now in the silver market, because the macro thesis and the physical reality are converging. In my last video, I showed you the biggest short squeeze in silver that nobody is talking about. A major bank hoarding physical silver, China getting caught short, LBMA seizing up, physical demand tripling year over year, COMEX vaults draining, miners selling at 26% premiums above the official price. That's the short-term catalyst. Tavi Costa's framework is the long-term catalyst. The short-term says silver is being squeezed right now. The long-term says the ratios support a multi-year move to levels most people can't imagine. When the short-term squeeze meets the long-term repricing cycle, that's when you get the kind of move that people talk about for generations. I'm not telling you silver is going to $3,947. I'm telling you the math behind that number is not crazy. The assumptions are aggressive, but the direction is supported by 100 years of data. And even the most conservative version of that math puts silver multiples higher than where it trades today. The question isn't whether silver is undervalued. It is. The question is by how much. And the answer depends on how much of the historical pattern repeats this time. I think a lot of it does. I could be wrong. I've been wrong before. But the Dow-Gold ratio has never failed to revert in 100 years. And the gold-silver ratio has compressed in every single precious metals bull market. I'm not smart enough to ignore both of those patterns at the same time. 2 ratios, 100 years of history. One conclusion. Silver's biggest move is still ahead of us. Drop a comment and tell me which target you think is realistic. 400? 600? 1,000? Or do you think the bears are right and supply will cap it? I'll pin the best from both sides. If you haven't seen yesterday's video on the silver short squeeze, watch it next. Link in the description. Because the short-term physical market and the long-term macro thesis are telling the same story right now. That's rare. And that's powerful. Share this with someone who thinks $3,947 silver is crazy. Show them the math, then let them decide. This is the hidden economy. Stay sharp, stay stacking, and I'll see you tomorrow.